In the third week of January 2026, something happened in Tokyo that shook the global financial system, even though it began in the most boring corner of money. On bond trading desks, traders stared at their screens in disbelief. A number they were looking at had just done something they were trained to think would not happen. Japan's 40-year government bond interest rate pushed above 4%. That sounds dull until you realize what it really means. It means Japan, famous for low rates for most of your adult life, was suddenly paying high interest on money it borrows for 40 years. And when Japan's borrowing costs jump like that, the effects don't stay in Japan. They ripple into retirement accounts, pension funds, mortgage rates, and even the prices of everyday goods. This is one of those stories that starts with a quiet market and ends at the kitchen table. For 30 years, Japan's bond market was the most boring place in global finance, and that was exactly why it was valuable. Japan kept interest rates near zero for an entire generation. While America's rates rose and fell, while Europe went through crisis after crisis, Japan stayed steady and predictable. Think of Japan like the world's cheapest credit card that never raised its rate. If you could borrow money at almost nothing, you could use that cheap money to buy other things that paid more. For decades, investors all over the world built plans around that simple idea. Banks did it. Big investors did it. Retirement funds did it indirectly through the markets they were invested in. When one country offers cheap money for 3 decades, the world quietly rearranges itself around that stability. That's why January 2026 hit so hard. It wasn't just a bond rate moved. It was the feeling that the cheap credit card finally changed its terms. And when that happens, people everywhere suddenly look at what they bought with that card and ask, "Can I still afford this?" One detail shows how fragile the moment was. Reports said that roughly $280 million of trading helped trigger a wipeout of about $41 billion in market value across Japan's bond market. Less than $300 million in trades, and $41 billion vanished. That's not normal. Imagine a dam holding back an enormous reservoir. You expect it to take enormous force to crack it. But if the dam is full of hidden weaknesses, sometimes a small push in the right spot starts the break. That's what this felt like. The market wasn't being held together by deep pools of buyers. It was being held together by confidence, and when confidence cracked, prices didn't calmly adjust. They lurched. This is especially alarming because Japan's government bond market is gigantic, around $2 trillion. A market that big should be able to absorb shocks. But the very long-term bonds, meaning the ones that don't get paid back for 30 or 40 years, had become thin and jumpy. Let me translate one phrase you may hear. When people say the long end, they simply mean those long bonds that mature decades from now. A 40-year bond is basically a promise that stretches across almost half a lifetime. The longer the promise, the more nervous investors get when the story changes. So what changed the story? A big part of it was politics colliding with math. Prime Minister Sanae Takaichi called a snap election for February 8, 2026, and her campaign messaging leaned towards stimulus, tax relief, and new spending. One of the most talked about ideas was a 2-year suspension of the consumption tax on food, estimated to cost about 5 trillion yen. To voters, that can sound like relief. To bond investors, it sounds like a simple question. If the government collects less tax, will it borrow more money? And when a government has to borrow more money, it issues more bonds. More bonds for sale usually means investors demand higher interest to buy them. That's not ideology, that's supply, demand, and fear. There's another number that sits in the background like a weight. Japan's government debt has been estimated around 237% of its GDP. You don't need to be a finance person to feel what that implies. It doesn't mean Japan is about to collapse tomorrow. Japan has managed this debt for years, and much of it is held at home. But it does mean that when borrowing costs start rising, investors become extremely sensitive to big promises. Some people compared the mood to the United Kingdom's 2022 crisis, what got nicknamed a Liz Truss moment. The point isn't that Japan is the UK. The point is that markets sometimes react violently when they hear we're going to cut taxes and spend more at the exact moment borrowing is getting more expensive. Now pause for a quick recap, because this is where the documentary can start to feel like a maze. So far, Japan's 40-year rate jumped above 4%. The move was violent. Politics added uncertainty, and investors started demanding more interest to lend. Now we get to the hidden connection that turns a Tokyo bond shock into global turbulence. It's the strategy built on Japan's cheap credit card. It's what Wall Street called the yen carry trade. Here's what that means in plain language. A carry trade is when you borrow money in a country where it's cheap, then use that borrowed money to invest where returns are higher. For decades, Japan was the cheapest place to borrow. So investors borrowed in Japanese yen at very low interest. They converted yen into dollars, euros, pesos, whatever they needed. Then they bought things that paid more, bonds with higher yields, stocks, real estate investments, and sometimes riskier bets. The profit came from the gap. If you borrow at 1% and invest at 5%, you keep the difference. When it works, it feels smooth, steady, almost like a money machine. But like any machine, it has a weak spot. It only works if two things stay calm. First, Japan's interest rate has to stay low. Second, the yen can't suddenly become much stronger. Because if you borrowed yen and the yen strengthens, paying back that yen becomes harder. You suddenly need more of your own currency, more dollars to buy the yen you owe. The loan shrinks on paper, but it grows when you repay it. In early 2026, both of those calm conditions began to wobble. The Bank of Japan kept its main policy rate at 75%. That's still low compared to some countries, but it's far above the near-zero world investors grew used to. At the same time, the Bank of Japan was slowly stepping back from years of heavy bond buying. If the central bank buys fewer bonds, investors feel less protected, prices become more sensitive, the market becomes easier to shake. Then came the currency drama. The yen had been weak, drifting toward around 160 yen per dollar, an area that has historically made Japanese officials nervous because a very weak yen makes imports like fuel and food more expensive. Suddenly, the mood shifted. The yen strengthened quickly as traders sensed possible official action. Reports described a rare rate check, meaning officials were essentially checking what it would cost to intervene in the currency market. Whether there was a direct intervention or just a loud warning, the message to investors was clear: you cannot assume the currency will stay calm. And for anyone who had borrowed yen, that is the nightmare scenario. Now we need one more simple definition: margin call. That phrase sounds technical, but the idea is basic. It's when a lender tells an investor, you must add cash right now, or we will sell your investments to protect ourselves. It's the financial version of pay today, or we take the keys. And when margin calls happen, people don't sell calmly. They sell fast. They sell what they can sell quickly. This is why market drops can look irrational. People see USS. Stocks wobble and ask, did the company suddenly get worse? Sometimes the honest answer is no. Nothing changed about the business. What changed was the hidden borrowing underneath investors' positions. Here's a concrete example that connects to the real world. Imagine a large fund borrowed yen to buy big US technology stocks, the ones everyone knows, the ones people think of as long-term winners. Even if those companies are still strong, the fund may be forced to sell, simply because the yen strengthened and the loan became harder to repay. That forced selling can push markets down, not because America's economy is suddenly broken, but because the world's cheap credit card just got more expensive. When cheap funding gets called back, it's like the tide pulling away from the beach. Things that looked solid start wobbling. Now let's connect this to retirement and everyday costs, because that's where a 65-plus viewer should feel the meaning. Japan isn't just a borrower. Japan is also one of the world's biggest investors. For years, when Japan paid almost nothing on its own bonds, Japanese institutions searched for better returns overseas. They bought US government bonds, they bought other foreign bonds, they invested globally because home didn't pay much. As of late 2025, Japan held roughly $1.2 trillion in US Treasury securities. That matters because US government bonds are the foundation for borrowing rates across America. If Japan and other big buyers become less eager to buy US bonds, the US may have to offer higher interest to attract buyers. Higher treasury rates can ripple through the system, mortgage rates can rise. Car loans can get pricier, refinancing can become less attractive. That is the chain from Tokyo to your life. It's not a straight line, and it doesn't happen overnight, but the direction matters, a shift in who buys you. Bonds can quietly change what American families pay to borrow. And it's not only mortgages. Retirees often care about stability, bond funds, fixed income, and the steady value of retirement accounts. When global bond markets get shaky, safe assets can swing more than people expect. This is where the missing nuance matters, and it's easy to say in plain English. When people hear interest rates rose, they often assume it's just one simple number changing. But in long-term bonds, investors also demand an extra fear fee. It's not a technical trick, it's common sense. If you're lending money for 30 or 40 years, you worry about surprises, inflation, elections, policy shifts, even the value of the currency. So when uncertainty rises, lenders don't just ask for a little more interest, they ask to be paid for the risk of being wrong for decades. That's what this moment in Japan really showed. Investors weren't only reacting to today's economy, they were suddenly charging more for tomorrow's uncertainty. Here's where Japan's inflation comes in, and I'll keep it simple. Japan spent decades fighting falling prices. But by late 2025, inflation was still hovering above the Bank of Japan's 2% target, even if it had cooled. That creates a painful choice. If the Bank of Japan raises rates quickly, it can slow inflation, but it can also worsen losses in long-term bonds. If it moves too slowly, the yen can weaken again, making imported food and fuel more expensive for ordinary people. So policymakers are trying to balance three worries at once: prices, the bond market, and the currency. And the hard truth is, you can't perfectly protect all three at the same time. This is why people started talking again about bond vigilantes, a dramatic phrase for a simple idea. Sometimes markets stop listening to comforting speeches and start enforcing discipline by demanding higher interest. It's like a bank raising the rate when it thinks the risk went up. Now pause for another recap, because this is the heart of the documentary in one breath. Japan's long-term rates jumped. Politics raised fear about more borrowing. The cheap yen borrowing strategy became riskier. The yen strengthened and shook investors. And global markets started adjusting to a world where Japan is no longer the calm, predictable anchor. That word, anchor, is important. For decades, the world leaned on Japan's stability without noticing it. Cheap yen funding became part of the background, like electricity. You only notice it when it stops being reliable. When Japan's bond market started moving in ways that suggested less control and more volatility, it exposed how many strategies around the world depended on Japan staying special forever. It revealed hidden leverage. It revealed quiet dependence. And that's why this moment felt like an earthquake. The earthquake isn't only one interest rate crossing 4%. The earthquake is the world realizing that the rules of the last 30 years may be changing. If you're asking, is this just a one-week scare or something bigger? The honest answer is that the direction has shifted. Japan's bond market now has to work with less central bank support, while politics is louder and inflation isn't just a memory. That doesn't guarantee a crash. But it does suggest more sudden shocks, more sharp swings, and more moments where investors are forced to unwind positions that used to feel safe. So what should a normal person take from all of this? Not panic, not day trade, not stare at the stock ticker all day. The useful takeaway is awareness. If global interest rates drift higher because big buyers shift behavior, borrowing can get more expensive, and retirement portfolios can feel bumpier. It's also a reminder to value resilience over excitement. In times like these, the most dangerous plan is the one that only works if nothing changes. And something has already changed. In the end, finance isn't only numbers. It's stories that people agree to believe until they don't. For 30 years, the story was that Japan would always be low-rate, predictable, and quietly supportive of global markets. That story is ending, or at least being rewritten. And when foundational stories change, everything built on top of them has to adjust. That's what you're watching, a global system learning how to function without the old assumption of endless cheap yen. If you stayed with this to the end, you already understand more than most people about how one country's policies can shape the world's financial weather. This channel exists to explain those hidden connections in plain English, without hype and without talking down to you. If you want more serious, no-nonsense breakdowns like this, stories that connect global events to your money and your daily life, subscribe to the channel. Because the next shock won't introduce itself politely either, but if you know what to listen for, you'll hear it coming.